The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, with recent volatility in the market, probably everybody is wondering, are we going to get the Santa Claus rally that will bring this suffering to an end?
Right. We're looking for Saint Nick.
So we are in the period of seasonality, but as I have pointed out in recent writing to other advisors, that the 20-year period that is used to figure out how seasonality should guide us hasn't included high inflation. It hasn't included two wars. It hasn't included the return to more normal interest rates. I'm thinking of 5% as a normal rate.
Which is, correct? Yep.
Which is, that's a long-term average. Yep. But as I was reflecting on that this weekend, if you'll excuse a little rabbit trail, one of the headlines was people have quit buying houses because they don't like mortgage rates at 8%.
Correct.
Well, my first house I bought on a real estate contract, so I'm not sure that's a fair interest rate comparison, but that was in 1978, and I got I think 7.25, 7.5, something like that from the seller. And then we sold that and bought another house in 90. And when we got done with construction and rolled that into permanent financing, it was 10 5/8.
There we go. Sure.
I said, well, I was paying 7, so this is the deal. That's just the market. And I think we'll reach a point where people will say, if rates don't come down and I want to buy a house, this is what it takes. That's what we did. Right. We said, we want the house. We need a place to live. We don't want to rent. So you pony up the money, yep. And 10 years later, we sold it and moved on. And the next house, we got a little lower rate going into it. That's the one we're in now. And then rates have come down. So with refinancing, you lower your interest expense, but you still have your shelter. You have your roof over your head. And theoretically, you can close your windows, keep the rain out.
Right. But like I said, it makes a huge difference. If you are, if interest rates are at 3%, there's a whole lot of interest in real estate at that point because it's virtually free money. Let's go buy something and flip it and buy something and flip it. Well, that equation gets much tighter at 7 and 8%. And now you're looking at people buying real estate that need the home. It's just a need-based thing instead of, hey, wouldn't it be fun to have a second or a third rental real estate property because those rates are so low, and that goes away when the rates get up at 8%. Now it becomes I need this home, otherwise I may not be able to justify getting into it.
Well, in fact, the rental may not cover the financing cost anymore.
Absolutely, yeah. That's where the real rub comes. It just gets too expensive to play in that field anymore.
So as people's expectations for interest rates have changed, it also changes the dynamic for what's going on in the stock market and what should we expect from stock market returns.
Sure.
We've been led to believe that the stock market averages, depending on whose report you're looking at, somewhere between 8 and 10% over, now listen carefully, over the very long haul. But they leave out the word very most of the time.
You bet.
And that number is really true if you just go back far enough. Data goes back into the 20s. And if you just draw an average line through the good and the bad years, that's what you get. But that's not adjusted for inflation. Now, if we adjust it for inflation, you get closer to a 6% number. And the question now is that even real with inflation where it is?
Correct.
Because inflation undermines your purchasing power. And we all understand that. You go to the grocery store and you see people taking things out of their basket at the cashier or putting them back in the basket saying, no, I can't afford that. I got too much up here already. Those are difficult choices. They're lifestyle choices, and they're very, very hard emotionally, psychologically, and financially. So the question that persists is, what should we expect out of the stock market? Should we expect that 8 to 10% return? Frankly, I think that's an unreasonable expectation because there is no accommodation for bear markets, especially bear markets in your safety investment. In this case, it's been bonds for 40 years, which have just been decimated by the Fed changing interest rate policy and raising rates aggressively. Rates and bonds in value are a teeter-totter. They
Correct.
can't both go up at the same time. And you have to keep that in mind when you look at, well, say a 60-40 portfolio, which is the most common portfolio recommended by financial advisors in the country.
And it's important to note, Don, you said that bond bear market's been going on for 40 years. That's longer than most people invest. So that's more than an entire investment lifetime. So people have that ingrained as an absolute. Here's the return we're going to get on our bonds going forward, and it's just not going to happen right now. The interest rates don't allow it. We can't have rates continue, that were artificially at zero for a decade. That's probably never going to happen again in our investment lifetimes anyway. And so to assume that that's going to occur again, and we're going to get those kinds of returns again, is just not realistic. And then when you combine that with the high inflation we're getting right now, equity returns closer to 6% than 10 going forward, if we can get to 6, bonds are providing no mediation to the volatility out there, and are in fact going down at the same time stocks are, and people are left wondering, well, what are we supposed to do? My whole investment world has been turned upside down. What are we supposed to be looking at here? How can we move forward not knowing anything about potential returns?
Well, one of the common references is work that has been done by Professor Jeremy Siegel, who's also a Nobel laureate for the research he's done in financial markets. Let's just put up briefly the total return chart on the various indexes: stocks, bonds, treasury bills, gold, and the dollar. Now the dollar is just falling out of line. This goes back to 1928, I believe. It goes back further than that. He goes back into the 1800s. And the dollar is depreciated in value because of the constant inflation. Now we've had periods where there's no inflation, but government works best, in their opinion anyway, when they spend money to get reelected. Now you may think they're spending money to build bridges, but they're not. They're only spending money to create economic activity in the neighborhood that they can affect and get reelected. And all of that excess spending has just lost any type of discipline since COVID. And we've ramped up the amount of federal debt, and now with higher interest rates, the deficit, the amount of money necessary just to pay our current bills, is skyrocketing. And within a couple of years, it's expected that the interest on the debt is going to be in excess of $1 trillion a year. That's really hard for the dollar to maintain its value as the global default standard for currency in the world, the haven for all currency and markets. The treasuries, the default asset for anybody looking for safety, ironically lending money to one of the most bankrupt entities in the global environment. But us. That is what it is.
Yeah,
we are the default currency for all trade. But the dollar continues to weaken. The cheap interest rates, basically zero rates for a long time, a decade, I guess, from 08, 09 until COVID. And that generated a lot of speculation, both in real estate and in the stock market. And those low interest rates made bonds look like, well, the people who already own bonds looked like they had a really good deal because their valuation was rising as that interest rate fell to zero. But now the game is turned. That reminds me, I go back to the teeter-totter. When you were a kid, did you have a teeter-totter in your backyard? Because we did.
Yeah, absolutely. Yep.
And you have a sibling who you're doing teeter-totter with, and they decide to jump off while you're high in the air.
You know, you can always see that look in their eye, and you're like, oh no, this is this is going to happen. Yes.
Yeah. Well, that's kind of where bond investors are. And frankly, I think that's where a lot of financial advisors are today, because the bonds that they've put in people's portfolios for safety, for income,
Right.
have just been decimated as far as the value is concerned. And well, you'll be okay in the long run doesn't sell well for years on end. And that's kind of where we're
Right.
coming up on the third year of negative returns for bond portfolios. This is
Amazing.
historic. We can
Yeah.
actually say this time is different applies to bonds.
Really
There's
does.
there's a lot of things where we say this time is different, and it turns out not to be that way. And maybe in the next couple of years, the Fed will start cutting rates and rates will come back down a little bit. But if you're expecting a real drop in interest rates and values to appreciate in your bond portfolio, you probably have some rose-colored glasses that you should take off, because this is a normal interest rate environment. We're just so used to being kids in the candy store that
Yep.
we don't like the fact that they've taken the candy off the shelf and they're
They
making
haven't,
us.
and you know, advisors, Wall Street advisors, they're not going to adapt. They're not going to come out and tell you, hey, this portfolio that we sold you 10 years ago is shot now, and it's probably not going to work, and everything needs to change. They're going to tell you, it's okay, just ride this out, because in the long run, everything's going to be okay. And they never get to the point where, well, it took 40 years of a bull market to get us into this portfolio. It may take 40 years for it to work out on the other side too. Do you really have 40 years to wait? And of course, the answer is no. No one's got that kind of time just to sit around and let their portfolio lose money, especially in what was supposed to be the safe portion of your portfolio. But those pie chart advisors, they are not going to change what they're doing. They're going to leave you in that 60-40 portfolio, regardless of what your outlook is. They are not going to change. And that's pretty dangerous. That puts your portfolio in a very risky situation.
Even most portfolios that are run on individual stocks instead of funds or exchange traded funds typically are managed the same way. So you own individual stocks, but they very rarely get sold because of bad fundamentals, bad earnings reports, falling profit margins. It's just that this is a good company and everybody should own some, because eventually the cycle will turn. But that's the question that you have to deal with as you look at your retirement and your needs for capital. Will you be able to wait for the cycle to turn in your favor before you need to use the money? The other big problem with the forecast for returns is that nobody ever forecasts a bear market. When you're doing, not ever, that's right. When you're doing retirement planning or planning for your kids' college education, any goals that you have, and you're relying on your portfolio to fund it, ask the advisor, where in this sequence of years have you prepared for a bear market that loses 25%?
Yeah, and it's not going to be there.
You probably get the deer in the headlight look. You know what I mean here.
They're not going to talk about that. They're not going to dial that into your portfolio. And everyone knows it's going to happen. Your advisor knows it's going to happen. They're just we're not going to talk about that right now land, because it doesn't make our graph look quite as good. So they'll just forget that part and deal with it when it comes up by trying to convince you to leave your money where it is, not that they're going to do anything different with your portfolio.
So the theory about 60-40 portfolio and having bonds as a balance for risk mitigation really didn't work. If you go back into the 60s and you work through the 70s into the early 80s, I mean, bonds were last place to be and stocks weren't much better. They were extremely volatile. What changed was when Paul Volcker changed monetary policy at the Fed and said, we're going to whip inflation now. Adapting, that was Nixon.
Correct.
And the win button. In any event, he changed policy, and it took two big recessions to finally get inflation's back broken. That's one of the reasons that currently Mr. Powell doesn't want to lower rates too early, because he's afraid of getting a second recession and have to raise them even higher than they are today. So he has to play catch up. They're already trying to struggle their way out of a mistake, big mistake, not recognizing inflation to begin with. But your expectations probably need to be toned down. I know when I left the brokerage business and started Investor Resources back in 1990, I bought into that 8-10% return, portfolio returns.
Sure.
Business was going to be easy, portfolios were going to grow. Little did I know, in 1990 we got a 30% drop in the market because of the Iraq War, and then we got the tech bubble, which decimated things. Took 13 years, almost 17 years for tech actually to recover its original highs and go beyond. And then right after that, in 08 and 09, we got another 30% decline. And it took 7 years to get back to even on that. The straight line assumption that you're using in your retirement planning needs some caveats in it. And if you want help doing that, we'd be glad to provide some assistance. You can contact us with the information here on the final screen. And for us, I think that's probably a wrap.
Thank you.